Hello learners, welcome to our session today. I am your instructor, CPA Ringo Frederick, and my good students, in our class today we are going to introduce a very important concept, a topic that was introduced at this level which was not there. So it will be very key that we should be able to understand and grasp each and every concept that Mwalimu is going to share today. And our topic that we'll be handling is known as a Introduction to Portfolio Analysis. This topic, large chunk of it is in advanced level, but under this revised syllabus, students in intermediate level, specifically students of financial management, you will be expected to handle this part here. Now, to introduce this concept, it will be very important for us to understand some of the specific elements. Like in this case, we are talking of portfolio analysis. So the big question that we are going to ask ourselves is, what is a portfolio? What is a portfolio? So in a summary, we normally look at a portfolio as a pool of investment, as a pool of investment. Because at this point you'll find that I might have various pool of investments. These are collection of either assets, talk about stocks, talk about bonds, etc. So it is a collection of investments. This is what you're terming it as what? As portfolio. So portfolio basically, anytime you're looking at portfolio, we are talking of what? As a pool of investments. This basically pool of investments. Pool of investment. This is what you're terming it as what? As a portfolio. Now the process by which we'll be analyzing these investments that you have in them, the whole investments that we do have, is what we'll be terming it as what? As portfolio analysis. So we'll be terming as portfolio analysis. And what is the main reason why we normally do invest? We normally invest for us to earn returns, right? The main purpose of investment is to earn the returns. And therefore, it will also be very vital that we understand the concept to do with aspect of, that is of course expected return of the portfolio, or return of a portfolio. It will be very key that we understand return of a portfolio. So I've invested in these pools that we do have, so that as at the end of the day, looking at the returns that we've earned out of these portfolios, I'm having, say, like 3 or 4 investment projects. So the returns that we're going to generate in our pool of investments is what we'll be terming it as what? Return of the portfolio. And many a times we will be expected to compute the expected return. When you're talking of the expected return of our portfolio, we are looking at it as what? As the average. Mean average returns. The average returns that we normally have in the portfolios that we do have. One common factor and something that will be constant in any form of investment, of course, is the aspect of risk. Aspect of risks. So you'll find that the whole concept that we'll be looking at under aspect of portfolio investments or portfolio analysis, the concept of risk will always be very key. The concept of risk will always be very key. And that should take us to analyze the aspect of risk. When you're talking of risk, basically, what should we have in mind? So talk about the concept to do with risk. Anytime, my good student, you are looking at risk, what should come at the back of your mind? So risk in general, we normally tend to look at it as a possibility of the actual returns being different from the expected returns. The possibility that whatever I was expecting to earn it will not be the case, because I'll be having certain component of differences which are either beyond our control. So risk, we are saying that there is a possibility. Things are uncertain. There is a possibility that my actual return will not be the same as whatever that I was expecting. And the good thing is that on this, we can measure risk. Risk can be measured since it is associated with probabilities of a given outcome. If I know that during state of nature, assuming that things are very okay at boom, I normally tend to expect this return. At moderate state of economy, I normally expect this return. And at low state of economy, I normally expect these returns. So you'll find that these factors are very we can assign probabilities to our outcomes. We can assign probabilities to our outcomes. So that should take us to measures of risks. That should take us to measure of risks. So in measuring our risk, we can always use the following. In measuring our risk, my good student, we can use the following methods. So we are saying that measuring risks, talk about aspects of, in measuring risk, you can use either. So this is measuring of risk. We are saying in measuring of risks, we can either use the following. In measuring of risks, we can either use the following. Number one, talk about concept to do with expected returns. So we can talk about expected returns. We can talk about expected returns. Number two, we can talk about aspect to do with variance. Number three, we can talk aspect to do with standard deviation. Standard deviation, SD. We can as well talk about aspect to do with coefficient of variation. Talk about coefficient of variation. Coefficient of variation. So basically, these are methods that you can use to measure our risks. These are the methods that you normally tend to use to measure our risk. And on that, we will dissect each one of them. Starting by number one, which in this case we are talking of expected returns. Starting by number one, we are talking of the expected returns. Expected returns. So anytime you're looking at expected returns, my good students, what should we understand? This is the mean average of all our collection of the returns that we are having. So we are saying that expected return basically is the mean average of the return of a given project. This is a mean average. This is a mean average of the expected, mean average of the return, mean average of the return of a given project. Mean average of the return of a given project, or investment. That is what would give us as expected return. Mean. It is a mean average. And when you are talking of a mean average here, we are looking at it as this point, my good students. Assuming I've invested, or rather assuming I'm having our returns, we are going to multiply by the probability. So summation of all that is what is going to give us what is known as what? Expected return. That is the return times our probability. We sum it up. That is what will give us what is known as what? What is known as the expected returns. Take, for example, look at this case, my good students. Look at this case. Assuming I'm given investment project A. assuming I'm given investment project A, assuming I'm given investment project A, I'm having investment project A with the following returns: project A, investment project A. This project A has a following state of nature. You're talking of boom, maybe you're talking of moderate, and you're talking of maybe aspect to do with low. Returns, maybe you're talking of 20, maybe you're talking of 25, and maybe you're talking of, say, like 10. Probability of this case of each state, maybe I'm having 0.4, maybe 0.5, and maybe 0.1. So how will we determine our expected returns? To determine expected returns, it will be very easy because we want to take the summation. So my expected return in this event, I'm going to take the return at the state of boom, 20. I multiply by the probability of that state, which is 0.4. We are going to add 25 by 0.5. We are going to add 10 by 0.1. So that as at the end of the day, what will be our expected return, my good students? My expected return there for that point, I should be talking of 20 by 0.4. We add 25 by 0.5. We add 10 by 0.1. Of course, that should give me 21.5. So my expected return, I should be talking of 21.5. That will be our expected return. That will be our expected return. So that's why we are talking of what? We are looking at it as a mean average. That's why we are looking at it as what? As the mean average, mean average, mean average. And that's how we can determine our expected return. So always have that in mind. Another key, what if in the event that you're not given your probabilities, how will you determine your expected return? In the event that you're not given your probabilities, my good students, how will you determine your expected returns? In the event that you don't have your probability, to determine your expected returns, of course, we can always take our total returns. Total returns. We are going to divide by the number of periods. Number of periods. We're going to take our total returns, we divide by the number of periods. That should give us what? Our expected return. That should give us our expected return. Total returns, we divide by the number of periods. Like in this case, whatever that we're going to do, if we didn't have probability, we could have summed up all our returns. Then you divide by the periods. In this case, we're looking at the states, which is 3. So 20 plus 25 plus 10, then you divide by 3. That will have given us the expected returns. That is what you should always tend to have in mind. Now, the moment you've grasped that concept, one key element that you should understand here is that the higher the expected return, the lower the risk. The higher the expected return, the lower the risk. Because you normally tend to say that returns, you'll find that higher returns, in that case, the higher the risk, the higher the returns. At this point, you're looking at it as a concept where you're saying that the higher the expected return, the lower the risk. The lower the risk if you were to measure it, because this is expected. So that is one thing that you should have in mind when it comes to the expected returns. After that, that should take us to the variance. That should take us number 2. Talk about variance. Ideally, variance, you'll find that this measures the percentage difference or change between our actual and expected returns. We are saying that variance, in this case, my good students, Mwalimu is saying that variance, it measures the percentage change or difference between the expected return and the actual returns. So we are measuring that difference, and to determine our variance, we normally consider this. First of all, I'm going to measure my actual return, the difference between my actual return and expected return. Okay, this time round we square that. times the probability. Then don't forget what? Summation of all that. So we are looking at it as what? Variance. Basically, we are saying it measures the percentage change or difference between the expected return and the actual return. And we normally tend to say that the higher the variance, the riskier the project is. That is why you normally tend to say that the higher the variance, the higher the risk. 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 So like in this event of ours, if we were to compute our variance, how would you have gone about it? In this case, I'm having 3 states. I'm having boom, we do have low, and you do have what? We do have moderate, and you do have low, right? So I could have determined my variance by taking my 20 minus expected, which is 21.5. I square that one times probability, which in this case is 0.4. I take at moderate 25 minus 21.5 because that is the expected return. I square that one times 0.5. The last one I'm going to take, that should be of course our 10 minus 21.5. We square that one, we multiply by 0.1. So that as at the end of the day, my good students, what will we be having as our summation of that? That should give us, the first one I'm having, 20 minus 21.5, of course, we square that one, times 0.4, I'm getting a figure of 0.9. So we're getting a figure of 0.9. 25 minus 21.5, we square that one, times 0.5. In that case, I'm getting 6.125. 6.125. And the last one, 10 minus 21.5. We square that one, of course, times 0.1. That should give me 13.225. So that if we sum it up, what should we be having? 6.125 plus 0.9 to give me a figure of 20.5. 20.25. So this will be our variance. This will be our variance. This will be our variance. So that is a concept to do with what? That's a concept to do with variance. That's a concept to do with variance. Another key element that again we should understand is a concept to do with standard deviation. Standard deviation being our number 2 item. Number 3 item. Talk about standard deviation. So looking at standard deviation again, you'll find that it's a very simple concept that we should understand because this is just an extension of the variance. Standard deviation, basically looking at standard deviation we normally look at it as an extension of the variance because whatever that we're going to do with standard deviation basically is one of the main elements that we normally tend to use to measure our risk. That is what we should always have in mind. And for us to determine our variance, basically, we normally tend to take our standard deviation being the square root of the variance. Square root of the variance. In other words, it's as if you're saying that our standard deviation will be equal to our return actual minus the expected returns. We square that one times probability. Then summation you should not forget so that we incorporate our square root. That will give us what is known as what? Our standard deviation. Like for example here in this question of ours, if I was to determine our standard deviation already, we have determined our variance to be 20.25. So in that case, whatever I'm going to do to determine our standard deviation will be simple because my standard deviation in this case, I'll just take my square root of the variance, which is 20.25, which would give us how much? Square root answer, that should give me a figure of 4.5. That is what you're going to term it as what? As our standard deviation. And remember, anytime we are to talk of that again, there is always a standard deviation of these portfolios or rather of these investments maybe a collection of all these investments, because at this point these are standard deviation of determining only a single, for a single investment, for a single project, for a single investment. This is what you are going to use to determine our risk. We measure our risk on that. But the big question would be, what if I am talking of a combined investments? Say we had A and we had B, for example. We had A and we had B, for example. Or rather in this case, how will I determine the standard deviation of the portfolio? So that is what I'll also want us to dissect here. And that is common, and you should be very keen with that. You never know. So to determine the standard deviation of the portfolio, remember this is for a single project. So standard deviation of a portfolio is D of a portfolio, standard deviation of a portfolio. This is how we are going to determine the standard deviation of a portfolio, my good students. We are going to take our standard deviation of our portfolio being, in this case, I'll be having this. So I'm going to take weight of project A, we square that one, times the standard deviation of project A, we square that one. We add the weight of investment B, we square, times the standard deviation of investment B, we square. Of course, we add to covariance of weight of investment A and weight of investment B. Then we should never forget the aspect to do with what? Square root. So this is how I can determine our standard deviation of a combined investment. And the combined investment is what you are terming it as what? As portfolio. Is what you are terming it as our portfolio. So basically, this is how we can determine our standard deviation of our portfolio. And as we'll be looking at a question, you'll find that it will be very easy now for it to sync. It will be very easy for it to sync. So that is the standard deviation. And we normally tend to say that the higher the standard deviation, the higher the risk. It is one of the main methods that measures that we normally tend to measure our risk. And that's why we are saying that at any given point you are comparing two investment projects. The higher the standard deviation, the higher the risk. The higher the risk, the higher the risk. At this point, we are introducing this item known as what? Covariance. Or also known as what? Correlation coefficient. Also known as correlation coefficient. Also known as correlation coefficient. Also known as correlation coefficient. So anytime you are talking of correlation